There are two things that whole life insurance can't do, but IUL can do. Why? Because Index Universal Life and even Universal Life was first introduced by E.F. Hutton back in 1980, primarily for living benefits, not death benefit. Wait a minute. What was the original death benefit? $1 million. Well, that means my cash value now has equaled the original death benefit. Show me a whole life policy that for every $1 million of cash value you have, that it can generate a 10% payout, $100,000 a year of tax-free income without depleting principal. That policy, that whole life policy, will crash and burn because of the guarantees. So what are the two things that whole life can't do, that IUL can do? So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth in the 3 dimensions. But if you've watched very many episodes on this channel, you will quickly understand that my favorite financial instrument, without question, is a properly structured, maximum funded, indexed universal life insurance policy. Now, I have a lot of critics out there, a lot of naysayers, and I listen to their reasoning and I roll my eyes because they simply don't know what they don't know. When I have whole life agents that say, whole life is far superior to indexed universal life because indexed universal life will be too expensive as you get older. It will crash and burn. The death benefit will just eat it up because of the cost of the insurance. Whole life has guarantees. I just go, oh my heavens, bless their little heart. They don't know what they don't know. So let me try to keep this as simple as possible. And then if you're interested, you can learn about the details because I'll gift you a copy of my book, The L.A.S.E.R Fund. You contribute towards the shipping and I'll cover the rest of that and I'll pay for the book. So let's get down to the nitty gritty and then I'll outline the two things that whole life can't do, that IUL can do. And I've yet to have any whole life agent show me how whole life can even come close. So, as I said, whole life insurance was primarily designed for death benefit. If all you're really looking for is an insurance policy where you're overpaying the early years so you can underpay the latter years by building up equity in the policy, it's called cash value. Whole life insurance may be a good way to go so that you can be covered with a death benefit for your whole life. That's how it got its name, okay? So you're way overpaying premiums for the early years. What I mean by overpaying, way more than the pure term insurance cost of insurance. Because all insurance policies, whether it's universal life, whole life, term, they all have the pure term cost, the actual mortality cost of the chance of you dying when you're 30 and then 31 and then age 32 and age 33. Every year you get older, insurance becomes more expensive, okay? So whole life is designed to where you way overpay level premiums the early years so that you build up equity or cash value in the policy so that when the cost of insurance would be higher than that, you have enough equity or cash value in the policy that it keeps you covered. It covers the cost of that insurance if you live to be 95 or 120 years old because the cash value, you have guarantees. And so whole life agents tout the guarantees. Oh, we have guarantees in our policy. And by the way, they're adjusting those down, which is going to cause a lot of turmoil. But nonetheless, that's what they tout is we have guarantees that will keep the death benefit in force for your whole life. Okay, well, if that's what you're interested in is a guarantee of a death benefit that will never lapse, fine, but you won't be able to use that policy for tax-free retirement income near as well as you can a maximum funded index universal life because index universal life and even universal life was first introduced by E.F. Hutton back in 1980 primarily for living benefits, not death benefit. That's the big difference, okay? They were trying to show people how they could more safely earn a rate of return by using the insurance company's general account portfolio. Back in the 1980s when they introduced this, where general account portfolio rates were, anywhere from 11.75% to 15.5%. I never got credited less than 11.75% and as high as 15.5% from 1980 to 1990 on my universal life policies. Interest rates are relative. But then interest rates started to come down and they introduced variable products. I've never owned a variable insurance policy, never will, because my 3,000 clients that I obtained from 1974 when I started until 1980 in 13 Western states were never happier than when I got them out of the market, out of those mutual funds and into universal life, where they were safe from market downturns. But let's get back to how universal life was designed in the first place. See, you're taking the least amount of insurance that the IRS will let you get away with and putting in the most money as fast as the IRS allows to turn it into a tax-free cash cow for living benefits that will far outperform IRAs or 401ks invested in the market, municipal bonds, or anything like that. It was actually designed to be buy term, invest the difference on steroids, to where you are self-insuring as early as 12 or 15 years into the IUL policy. Now, if you say that to a whole life agent, they'll get a deer in the headlight look. They don't even know what I'm talking about. Let me explain it. Many of my clients would come to me at age 55 or age 60 or 65, okay? Even 70, 75, 79 years old. Let's say you're age 60. If I had a 60-year-old come to me and they wanted to increase the liquidity, safety, rate of return, and the tax benefits on underperforming or non-performing assets, they may want to reposition $500,000, okay? Very common amount, where they came and they might have $200,000 net they're going to get out of their IRAs or 401ks, get the taxes over and done with sooner than later, and put the net of $200,000 into an IUL policy, because it will actually far better perform than leaving it in an IRA or 401k invested in the market. They may have another $200,000 that they get out of a rental property that they're sick and tired of being the landlord, taking out the trash, evicting tenants, fixing toilets, and they say, we just want to sell this and take the $200,000 and put it into an IUL policy. Maybe they have another $100,000 of underperforming assets in a bank or credit union or an inheritance or whatever, okay? So I'm super simplifying here. They have $500,000. They want to reposition that $500,000 into a portfolio that will be liquid so they can access their money when they need it, safe. They have safety of principal. Any year they make money, that becomes newly protected principal, but they don't lose when the market goes down. They want to have a nice, predictable rate of return, averaging, 8 to 11%, sometimes higher, and they want it to be tax-free. Well, insurance, permanent insurance, is one of the very few vehicles in the Internal Revenue Code that for over a century, 108 years to be exact, allows you to accumulate your money tax-free, and then you can access your money, including all your gain tax-free, and when you die, anything you leave behind blossoms, increases in value, and transfers income tax-free. That's under 3 sections of the Internal Revenue Code, Section 72E, 7702, and 101A of the Internal Revenue Code. But you have to comply with 3 tax citations called TEFRA, that's the Tax Equity Fiscal Responsibility Act of 1982, DEFRA, which is the Deficit Reduction Act of 1984, and TAMRA, that's the Technical and Miscellaneous Revenue Act of 1988. You can comply with those 3 tax citations better, faster, and more efficiently using universal life, index universal life in particular, than you ever can with whole life. Whole life, you have to spread out your funding over 7 years. It's called the 7-pay test. No, you can do it in less than 5 years, even 4 years with universal life. Basically, it means you can get in more money faster and get away with less insurance using index universal life than you can whole life. So let's go back to this example. This client comes to me and they want to reposition $500,000. If they're 60 years old, I can get by with only insuring them with $1 million because they don't come to me wanting or needing life insurance per se. They want the best rate of return on their $500,000. If they came to a whole life agent with $500,000, they would have to have way more death benefit than $1 million, and that would drain out a lot of their rate of return. Not only that, it would take 7 years to get in the $500,000. With me, it would take 4 years and 1 day at the most, okay? I can get the 500 grand invested faster, and I can get away with less insurance, so it's cheaper. What does that mean? Once they get that 500,000 in, which is in 4 years and 1 day, they put in 100 grand the first day of the first year, 100 grand the first day of the second year. So the first day of the fifth year, which is 4 years and 1 day into it, they have their 500,000 into their universal life policy. They've complied with TAMRA. It's not a modified endowment. It would take another couple of years to do that with whole life. So in 4 years and 1 day, I have my 500 grand into the IUL policy based upon actual historical rates of return, okay? That money, that 500,000 will likely double to $1 million within 7 more years. This has happened with many, many of our clients earning average net rates of return after the cost of insurance of 9.6 to 10.07%. Okay, so let's move into 7 on top of 4. That's 11. Let's go to the 12th year. In the 12th year, I have $1 million in my IUL policy. This has happened numerous times with my clients. Wait a minute. What was the original death benefit? $1 million. Well, that means my cash value now has equaled the original death benefit. So I only have at risk, what? Nothing. Because the cash value now has equaled the death benefit. And so if you're trying to use it for living benefits, you have the cash value qualify as part of the death benefit. Now the cost of insurance is Zippo. But under TEFRA and DEFRA, the death benefit has to stay 5 percentage points ahead. And so if you happen to die in that 12th year, the insurance company would pay out $1,050,000. But they're only charging you for $50,000 of insurance. Even though you're 12 years older, the amount of insurance is 1/20th what it was. Are you getting it? The interest you're earning on $1 million is way more than the cost of insurance of the net amount at risk of 50 grand. I am self-insured. If I don't need the money, that $1 million doubles in another 7.5 years to $2 million. Now, if I die, they'll pay out $2.1 million, but the insurance company's only charging me for the remaining $100,000. Why do I need guarantees in a whole life policy when I don't have any insurance at risk? My cash value is the death benefit because my cash value has grown to equal and exceed the death benefit, and it's moving ahead of it. The insurance company is going to pay out 5% more than the death benefit. And the rate of return on my money is way greater than the actual cost of the minuscule amount of net death benefit if I happen to die. It just keeps growing like crazy. So that is something that a lot of whole life agents don't understand. I become self-insured. Why do I need the guarantees in a whole life policy that I'll have the original death benefit of $1 million when I have $2 million by the 17th year? I have $4 million. I have way more than why do I need any guarantees? My death benefit is way more than it was when I started by double, triple, quadruple. So what are the two things that whole life can't do, that IUL can do? Whole life insurance, no way have I ever seen a whole life policy that if you even started as early as age 35, let alone age 60, that the cash value, okay, that it grew to at age, let's say 65 or 70, you just pick, that the cash value somewhere around retirement age, 60, 65, 70, that if you calculated the net internal rate of return cash on the premiums you paid into it, most whole life agents don't even know how to calculate IRR, internal rate of return. They're not taught that. Is within 1% of the gross rate of return. What I mean is this. For many of our clients, by age 60, 65, the internal rate of return cash on cash has been over 10%. They've actually been averaging by rebalancing 11.17 by diversifying and rebalancing, because some years they get credited 15, 16%, 25%, 61%, and what have you. Other years they don't make anything, but they don't lose. So if they average 11.17 like I have, they net 10.07. Show me a whole life policy that the internal rate of return by age 65 is within 1% of the gross rate of return. I've never seen one do that. In fact, the best one I've ever been shown was a Northwestern Mutual policy, and it took until age 95 before the cash value was within 2%, within 2% of the gross rate of return. They used 8% as the gross crediting rate, and the net internal rate of return to equal the cash value at age 95 was 5.9%. That means 2.1% of the 8 percentage points drained out the cost of insurance on the whole life policy. In the meantime, the universal life at age 65 was within 1% of the gross rate of return. I was able to earn 11 and net 10. With whole life, I had to go till age 95 and earn 8 to net 5.9. So that's the first thing that whole life can't do. It cannot perform within 1% of the gross rate of return by age 65. The second thing is, if you retire at age 65, show me a whole life policy that for every million of cash value you have, that it can generate a 10% payout, $100,000 a year of tax-free income without depleting principal. That policy, that whole life policy, will crash and burn because of the guarantees, okay? The guarantees aren't a plus, they're a minus. You cannot have a whole life policy generate a 10% payout. I've yet to see anybody illustrate that. In indexed universal life, $1 million of cash value can generate $100,000 a year of tax-free income from age 65 to age 120 without depleting principal by using rebalancing and diversification and index loans based on actual historical performance. So the second thing whole life can't do is it can't generate a 10% payout without the policy crashing and burning. Other than that, I don't have any strong feelings on this subject. But the sad thing is there's a lot of critics and naysayers out there, and all they say is, universal life is expensive, it will crash and burn. No, it won't. It actually grows to where the cash value equals or exceeds the death benefit as soon as 12 years into the policy. And from that point forward, there is no cost of insurance because the cash value is growing and just pushing the death benefit ahead of it under TEFR and DEFR guidelines. So hopefully this is giving you some insights that maybe you didn't understand before. If you want to learn more about this, you can, if you're a producer and you want to learn more, check out IUL Insiders and we can teach you this in depth. If you're a consumer, I would recommend that you study my book, The L.A.S.E.R Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. So this is a 300-page book. It's my 11th book. It's flying off of our warehouse shelves. I don't want you to miss out. It retails for $20 on Amazon plus shipping. I'll pay for the book. Simply go to laserfund.com or click on the link below. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But while you're in there claiming your free copy of this book, if you like to listen and learn or watch and learn, check out the audio and video. There's master classes. You can even schedule an appointment with an IUL professional that has been certified as a professional, passing a proficiency exam, and they can show you how to do this correctly so that you can see what I'm talking about here, because it'll make all the difference in the world. And if you say thanks but no thanks, you won't get a bill or invoice. There's no cost or obligation to have an IUL professional create hypothetical illustrations for you, but I implore you to make sure you do it correctly if you want to implement these strategies. So here's to you and your brighter future.